I just invested a big chunk of change to become fractional owner and make passive income this year. The money I expect to make will be dividends paid for the hard cash that I get for choosing the right place to put my money. In case you're new here, I'm Peter. I'm an investment enthusiast who wants to get the most out of my money while doing the least amount of work. Whether you're someone who's starting out in the world of investments or an accredited investor and looking to get into the world of the top 1% by making your money work for you, welcome. By the end of this video, you'll learn what fractional ownership is and how you can get paid passively through investments. Before I tell you about all the investment vehicles you can fractionally own, let's talk about the idea itself. Fractional ownership allows multiple investors to collectively own a portion of an asset, such as real estate or an online business, enabling diversification and access to investment opportunities with lower capital requirements. You might be asking, Peter, why would I want to buy part of an asset that generates money? Good question. Owning anything outright is hard. Let's say you buy an e-com store. You know, the ones you're buying random stuff on before the holidays. Those stores aren't anything but buy and forget. After you buy this e-com store, you need to worry about, website performance, user experience, product inventory management, payment processing and security, order fulfillment and shipping, customer service and support, marketing, promotion, data security and privacy, analytics and performance tracking, competitive landscape and marketing trends, legal compliance. The list goes on and on. Not to mention that you'll need to come up with quite a chunk of change to buy a successful e-com store outright. And there's also a lot of know-how involved in recognizing successful investments. And you'd probably prefer diversifying your investments and not taking all your money and put it in one basket. So what if I told you you could buy a portion of a basket of a profitable asset, handpicked by experts, and have professionals look after them while you sip martinis and wait for the profits to roll in? Well, guess what? You can do precisely that. Let's go over a few assets you can fractionally own and how to do so. We'll go over 4 in this video. Real estate. Let's start with old tried and true real estate. Real estate has long been regarded as the way to wealth accumulation, offering both steady rental income and the potential for substantial capital appreciation over time. You can get a piece of the real estate action with the help of REITs, R-E-I-T-S. A real estate investment trust called a REIT is a company that owns, operates, or finances income-generating real estate assets such as commercial properties or rental apartments. REITs offer investors the opportunity to invest in real estate without directly owning or managing properties, typically distributing a significant portion of their income as dividends. In my mid-30s, I was sure I'd never own real estate, not even a home. It was one of my dreams. This wasn't because I was wise to the problems of real estate, like finding good tenants, being aware of the bubbles that can form in the market, and so on. It was because I thought it would tie me down. Although I'd still think twice about getting into real estate, fractional ownership and investing in the diversified group of properties where I don't have to worry about the upkeep is an infinitely easier investment for me to consider. Real estate has many benefits: steady income, appreciation potential, diversification, tangibility, and tax benefits. I know the real estate market can be volatile, but that's where REITs allow you to diversify your risk across several properties and let the pros manage them. Performance-wise, real estate has appreciated a steady of 3 to 5% over the last 25 years. Let's talk about art and collectibles. Do you guys get abstract art? Even if you don't, you'd probably like to get one like the Interchange by Willem de Kooning. I don't know if I said that right, which sold for a whopping $300 million about a decade ago. Art has shown a strong record for appreciation across periods of transition for about 2 decades. It also seems to perform during periods of high inflation. According to Masterworks, which we will talk about in a bit, the contemporary art asset class has returned 13.8% annualized from 1995 to 2021, much more than the 10.2% from the S&P 500. Historically, this has been an asset class that restricted to the wealthiest in society, but now with the magical concept of, you guessed it, fractional ownership. You get to join the likes of Jeff Bezos, Leonardo DiCaprio, and Oprah Winfrey and invest in art yourself. The best platform to invest in and improve your portfolio is probably Masterworks. You get to build a diversified portfolio of iconic works of art curated by industry-leading research and acquisition teams. Let's talk about online businesses, digital assets, online entrepreneurs. Buckle up, folks. It's time to talk about our favorite assets to invest in here at Web Street. I'll give you a few hints. Salesforce, SaaS, software as a service, Amazon, e-com, the Huffington Post, content, Shopify, e-com, Canva, SaaS. Online businesses have emerged as some of the most lucrative ventures for investors, from e-com giants and SaaS platforms to affiliate marketing websites and content creation hubs. The diversity and profitability of these digital enterprises are truly astounding. Let's talk some numbers. The e-com sector is booming, with revenue in the e-com market projected to reach $3.23 trillion in 2024. I'll put the links below. The global SaaS market size was valued at $237 billion 2 years ago and is projected to reach $908 billion in about 5 years. The best part? Profit margins can soar up to 80% due to low ongoing costs. There are other business types as well, such as content sites and affiliate marketing sites. The best things about online businesses are scalability. Unlike traditional businesses, online businesses can scale quickly with relatively low incremental costs. Flexibility. Owners can operate from anywhere in the world, tapping into global markets. Diverse revenue streams. From subscription models to ad revenue, online businesses offer multiple ways to generate income. The major drawbacks of online businesses historically have been high competition, technical challenges like running online businesses does require a certain amount of technical know-how. Also, some market volatility. Trends can change rapidly, affecting profitability, so you have to be on top of these. Due diligence in the online space is notoriously difficult. Evaluating a website's traffic, revenue, authenticity, and growth potential requires some serious expertise. This is where platforms like Web Street have changed the game. You get to enjoy the upside and skip out on all the hard work. We have experts running the show, finding the best businesses, doing the vetting, running and growing them afterwards. Web Street conducts thorough due diligence, vetting each operator before it's listed and acquired. This allows investors to buy fractions of high potential cash flowing online businesses, such as content sites, Amazon storefronts, micro SaaS businesses, and more, to diversify their investments into passive and cash flowing portfolios. You know, I've always thought that I know how to grow a company from 0 to 1. And I can tell you from personal experience that the startup period is really hard. I've done it a few times. That's why my discovery of fractional ownership as a way of unlocking business ownership without putting in as much time and effort, trials and errors and sweat, this has been life-changing for me. It's turned me from being a lurker to an investor who's diversifying his portfolio and generating passive income. Stick around. Next year, I'll give you a report on how it's been so far, but I'm excited about this new asset class. Let's talk about the epitome of luxury: private jets, luxury vehicles, and yachts. Once reserved for the ultra-wealthy, fractional ownership has opened the doors to these high-end assets for our broader audience. Companies like NetJets and FlexJet for private jets, Curio Invest for luxury cars, and CNET and Smart Yacht for yachts. They offer fractional ownership opportunities that allow you to own these luxury assets without the full expense or hassle of sole ownership. What you're hoping to buy are assets that have the potential to appreciate in value over time. The Ferrari F12 TDF, I hope I said that right, for example, was $450,000 in 2015. But today it's valued at just shy of $1 million, $998,000. The usual risks with these assets are the crazy depreciation for the most modern luxury vehicles and the market volatility and sensitivity to economic downturns. That being said, I have to warn you about doing your homework on these and any other opportunity we talked about so far before putting in your hard-earned cash. Much like the other asset classes in our list, the right selection of assets has the potential to outperform the S&P and at the very least provide a great way to diversify your portfolio. So if you're an aficionado of luxury vehicles, look into this opportunity. And there you have it, folks. A glimpse into the world of fractional ownership across a diverse range of asset classes, from real estate to fine art to online assets and the pinnacle of luxury with jets, cars, and yachts. Remember, the key to successful investing is diversification, research, and understanding the unique risks and rewards each asset class offers. Fractional ownership can be your gateway to building a diverse and dynamic portfolio. If you found this guide helpful, give it a thumbs up and don't forget to subscribe for more insights into making your money work for you. Have questions or want to share your experience with fractional ownership? Drop a comment below. We love hearing from you. Until next time, keep investing smart and living the life you've always dreamed of. This is Peter signing off. Stay savvy, investors.